It's Dave. In this video, we're going to talk about why I feel rental properties are the best way for you to protect for your retirement income and why it could be better than your 401k. I'm going to give you four main reasons of why I'm investing in rental real estate and break that down as to what the categories I'm looking for, the benefits to having rental properties, and how you can earn wealth tax-free in the future. So I'm not against 401ks. I think you should be contributing to your 401k. At a minimum, you should be putting in what your employer would match into your contributions. But there's a downside to the 401k. When you get to retirement age and all of that money has grown tax-free, that 401k now becomes your taxable income. So if you need to obviously pay rent or pay your mortgage, all that money that you withdraw from your 401k during that year is now going to be taxed. You saved it tax deferred. You protected your income while you were, in your 30s, 40s, 50s. You lowered your taxable income there. But now that you're in your 60s and 70s, that's your job, and you're going to pay tax on that money that comes out of your 401k. I remember my father needed to purchase a car, and was going to pull, I think, this is several years ago, like $20,000, $25,000 out to purchase a brand new car. But that event creates a taxable event for him. His income is now going to be $25,000 higher for that year. So he has to pull an additional, I think at the time it was like $7,000 or something out of his 401k that year to pay taxes. So that really set with me as something like that just doesn't seem fair, that you've saved all of that money and now that you don't have a job, why are you still paying income taxes on the money that you've saved? And it's because he took the tax deduction earlier, and many people do. So let's look at this kind of income statement that I used in a previous video, where we're going to be having a rental property here as an asset, and that is going to be putting money into our pocket as an income. We're going to have a mortgage against that property. That's going to be a liability, and that comes out as an expense. And so this is kind of a typical setup, but the one caveat to this, and the number one, well, this is the number one reason that I am investing in real estate for my retirement, and that is cash flow. So let's say in this particular instance, this mortgage and my property taxes and insurance and all of that kind of stuff is $20 or $2,000 a month, and I can rent it out for $2,400 a month. That nets me $400 a month in cash flow. So that's like a job, and I don't have to wait until I'm retired to do that. I could be doing that with a rental property right now, making $400 a month of positive cash flow after all my expenses are paid. Now you're going to want to budget for repairs. The insurance usually goes up and things like that. If you're paying a property manager, they're going to take a cut of the rent, but we shoot for something like a $300 or $400 a month positive cash flow after everything is paid for, and treat that like it's a really like a mini income. And that's making me money like right now, and will continue to do that potentially even more as rents go up, hopefully, down the road. The second reason that we're doing this is we have something called depreciation. And this is what makes that cash flow tax-free. And so the way that works is the IRS views this rental property as a piece of equipment, and equipment in a business loses its useful life. And in this case, for a home, it loses it over 27.5 years. Now, I don't know where they came up with that number. I didn't come up with that number. But that's the value of the structure, not the land. You have to separate the land from the structure, and you get to depreciate that over 27.5 years. So let's say you bought the house for $350, and you go on the tax records and you see that they're taxing you, that the land value is 50 and the improvements, that's the structure, is 300. You would then take 300,000 and divide that by 27.5, 300,000 divided by 27.5, and that gives you $10,909 of depreciation per year. You get to use that to offset this $400 or $4,800 a year of income, as you don't pay taxes on it. So what you're essentially showing on your tax returns is that you've actually lost, let's see, minus 4,800. You've actually lost $6,100 on this property from an accounting standpoint, because the value of that home is depreciating over 27 and a half years, the value of that structure. Now we know that home prices generally, except for, maybe the end of last year and a small period of time between like 2008, 2011, historically they tend to go up. But this is more like a piece of business equipment. If you were a company that ran an excavation site and you had to buy bulldozers and they're taking a beating, they allow for businesses to depreciate the value of those tools over a certain period of time. And it's the same with this rental property. It is an income producing property. The structure, and if you think about it, you're going to replace the roof, you're going to the appliances wear out, you might need to put a driveway in. In fact, they have lifespans that if you were to do a separation of all of this in what's called a cost segregation study, where a fence or landscaping would depreciate at 5 or 10 years and 17 years, and there's different ones, and I don't have all of that. Incidentally, I am not an accountant, and this is not tax advice. It's not financial advice. This is what I'm doing as a real estate investor. It's what I know as a realtor, and I'm just sharing that information with you. So we've got this property now is generating cash flow, real cash flow that's going into our bank account. And then from an accounting standpoint, is producing tax losses because of the depreciation. Now, every once in a while, we're going to have to put a roof on and we're going to need to replace the refrigerator and things like that. But that should be budgeted in our monthly expenses, and we should still be generating the cash flow regardless. So then the third reason that I do this is appreciation, because you're leveraging the appreciation. If I were to put, let's say, on this $350,000 property, 20% down, that's 70 grand. If I'm going to try and invest 70 grand in the stock market and it makes 10%, I'm going to get, $7,000 a year. But if I'm getting 10% on $350,000 because I've now leveraged that into a rental property, then I'm getting $35,000 a month in appreciation. So I've almost gained half my money back if I get a 10% appreciation. Now, no guarantees you'll get 10% appreciation, but they do have something called forced appreciation, which you can get from putting in a new kitchen, making a 3-bedroom into a 4-bedroom, putting a pool in. There's all kinds of different things that you can do to this structure to force it to be worth more and not rely on just the overall market going up. So many people will take, say, like a 4-bedroom, 1-bath home and eliminate one of the small bedrooms and make it into a master suite. So you now have a 3-bedroom, 2-bath, but it's got the ensuite, and that might actually generate more value for you. Or if it's only a 3-bedroom, 1-bath, you might find some square footage where you could put a second bathroom in. You can get more rental income that way, or you could resell it for more. So you don't have to rely just on the overall market to get appreciation in this property. But you can see how if I turned $70,000 into a $35,000 gain each year, that's a little bit better than if I had the same percent return in a 401k. Sorry, you can't see that. That's a little bit better than if I got the same return in a 401k at 10%, where if my home goes up by 10%, it's going up at the purchase price and not at what my investment money price is. And then the fourth reason that you get this is, or the benefit to this is, you got the debt pay down. So every month, not only am I getting $400 of positive cash flow on this, but as my tenant is paying this mortgage down and this balance is going down, 200, 300, 400, depends on what the loan amount is, but you're reducing your principal here by probably around $300 in this scenario. So that is getting you a net worth. It's growing your net worth because now the value of that home and the amount you owe on it, that gap is getting bigger, and that difference, your equity in that is your net worth. When you do go to sell that property, then that benefits you to have that much more money. You could also use it to leverage maybe a cash out refinance later on down the road, and actually put a big chunk of cash in your pocket tax free, because that's a loan. And if you have something that you have to pay back, that's not considered taxable income. That's money down the road that I could cash out, refinance, maybe put 50 grand, take that out. If it still produces the cash flow because interest rates have dropped, then I can just put $50,000 of tax-free money in my pocket, continue to get the $400 a month of cash flow, still have the tenant pay that debt down. I'm not paying the debt down, they're doing it. And that's how it works. You're getting tax-free income. You can also, this $6,100 in the negative, you can use to offset any additional income. Like if I had W-2 income coming in, there's some limits on this. I think it's 25,000. Don't quote me. Talk to your CPA, of active income that you can write off against your other income, not just your rental income. So if I had 10 properties of this exact same nature, and I was writing off $61,000 in losses essentially, then, and I had a $61,000 W-2 job. Well, actually, if it's capped at 25, that wouldn't work. But if you're a realtor, then you can write off $61,000 of your income because you're actively in real estate. So talk to your tax accountant about that. But for me, as a real estate investor and a real estate agent, I get no limits on how much I get to deduct on other income sources that come in. The stuff that comes in here, if I have 10 rental properties giving me this much in deduction, I can essentially make that much money tax free. And that could be happening right now before I'm retired, and then happen infinitely as long as I've got those rental properties producing that income. So hopefully that kind of explains why I'm doing this. I'm not against the 401k. We contribute to 401k every week. And I'm a big believer. I follow the stock market closely and am very engaged in that, and do believe in the overall market as a good strategy. I just like the idea of not having taxes come into play 20 years down the road for not working, just taking money that I've already made, and now just because I'm retired or I'm over a certain age, now all of a sudden it becomes taxable. I like this way of generating income without having to pay the tax on that. So that's why I'm doing it. I'm actively looking at real estate. I am going to look at a rental property tomorrow. I get emails daily from different wholesalers that send me deals that I'm looking at to actively participate. I'm not waiting to buy the dip in real estate. I'm not waiting for interest rates to come down. If they come down later, I'll refi, no big deal. But if the numbers work today, I'm not worried if the purchase price that I pay now is less in 3 years. I'm not in the market to sell these at any point in time. I'm just generating the cash flow and getting the depreciation that's giving me the tax write-off. So that's how I feel about it. I'm super excited to buy more of these. I want to buy as many as I can, and then I'll get into multifamily, and I'll get into other avenues that way. But if you've got questions about this, comment below, and I'll answer it as best as I can. If you want, to talk more about this with your CPA, I would recommend you doing that, getting your ducks in a row before you make a purchase and then realize that something doesn't work for your situation. But that's all I've got. Thanks a lot for watching, and I'll talk to you guys later.